In this video, I want to talk about the pitfalls, the disadvantages, the drawbacks of investing in government bonds. When it comes to investing in government bonds, actually, there are some disadvantages that we need to understand before we make up our mind to actually invest or not. Number one is lower yield. Government bonds typically they offer lower yields compared to riskier investments like corporate bonds, or equities, which may not meet the needs of investors seeking higher returns. Actually, if you are the type that wants higher returns, then of course, government bond is not for you. But if you're the type that you lack the risk appetite, the risk tolerance, and you want something that you know, harbors around safety and predictable returns, then of course you can go for government bonds. Number two is interest rate risk. Interest rate risk. Government bonds, are sensitive to changes in interest rates. If interest rate rises, the market value of existing bonds will fall, potentially causing capital loss for investors who sell before maturity. There's this inverse relationship between uh, interest rates and bond yield. When interest rates rises, bond yield will drop, and when interest rate drops, bond yield will then climb. And so there's that risk attached to movement of interest rates as far as bond investment is concerned. Number three is inflation risk. Inflation risk. The fixed interest payments, that is associated with government bonds may not keep up with inflation, eroding the purchasing power of the bondholder, over time. So this particular risk that the interest rate you receive, the coupon you receive as a bondholder may not be able to keep up with inflation. It's a real disadvantage, one ought to take into consideration. Number four is opportunity cost. And because government bonds tend to offer lower returns, investors may miss out on a higher growth opportunities available in stocks or corporate bonds. There's one thing about investing. When you invest in a particular instrument, you have to forego some other instruments. That opportunity forgone, is what one should take into consideration. As if you are, getting a lower rate, a lower yield, in a particular instrument, you could be getting a higher risk in another instrument, assuming you were invested, in that particular security. So there's that particular opportunity cost. You kind of lose out of stocks, and then because you are invested in bonds. Number five is unlimited capital gains. While government bonds can appreciate in value due to falling interest rates, they typically do not offer the same level of capital gain, that is obtainable in, growth-oriented instruments like the stock market, like, a typical stock investment. And so when you invest in stocks, you have that capital gain, that appreciation, that compounding, which of course is completely absent when it comes to investing in bonds. A stock can grow by 10, 20, 50, 30, 100% and above. But when it comes to bonds, that growth is virtually absent. You only have to rely on whatever you get, as your coupon rates. And so there's some limitation when it comes to capital gain. Number six is taxation. While government bonds may be exempted from states and local government taxes, the interest income is still subject to federal income tax, which may reduce the after-tax return for some investors, especially those, in the higher tax bracket. You could be exempted from tax in one area, but the federal tax is still waiting for you. And so there's no complete escape when it comes to the issue of your income getting taxed. And this taxation is done, based on your income bracket. If you're in a high income bracket, you'll be taxed at a higher rate. If you are in a lower income bracket, you could be taxed at a lower rate, but the tax is always present. Number 7 is reinvestment risk. Reinvestment risk. If interest rate declines, government bonds may be called, you know, or matured early, requiring reinvestment at lower yield, which can reduce overall returns. The issue is that the government have the right to do what, to call their bonds before it gets to maturity, and if it is done at a time that is not favorable to you because of the prevailing interest rate, then of course that will eat deeply into your expected returns. Please like this video and subscribe to this channel if you've not done that. Number 8 is long-term commitments. Long-term commitments. Government bonds with maturity dates. Example, some of them, as far as long as 20 to 30 years. It will lock in your capital for an extended period, which may not be suitable for those needing, more flexible or wanting access to their funds early. So once you invest in bond, except you want to discount it in the market, then your capital is locked in kind of, for a very long time, maybe 10 years, 20, 30 years. Your money just locked in there, yielding, marginal coupon, marginal interest, compared to if you put it in stocks, that liquidity is there. You can, withdraw your money whenever you feel like by selling your position, but that's not obtainable when it comes to bond investing. You have to wait for that duration, or you discount, you sell off your bond in the market, probably at a discounted rate. So it's a long-term commitment. It's not for those who are looking for short-term returns. Number 9 is currency risk, for those who are investing in bonds outside their country. If investing in government bond issued by foreign countries, investors may face currency risk as fluctuation in exchange can impact returns. Generally, this currency, fluctuation, and depending on how it goes, it can even eat into your returns, as a bond holder. So you need to have at the back of your mind that, if you want to get involved, in bond holding outside your country, always factor in the impact, currency fluctuations, the forex market, could have, in the overall return of your bond investment. Number 10 is market volatility, for long-term bonds. Long-term, government bonds can be more volatile, especially when interest rates, rise, as their price are more sensitive to rate exchange than shorter-term bonds. For those who are, holding a long-term bond, this bond, performance is always, regulated, influenced, or impacted by the interest rate. If interest rate is high, the bond value will go down, and if interest rate is low, the value of your bond will go up. But have it at the back of your mind that as a long-term bond holder, you get to encounter these challenges compared to if you are, holding the bond for the short term. These disadvantages make government bond less attractive for investors seeking higher returns, or those who want to avoid potential impacts of inflation and interest rate fluctuation, as well as taxation. However, they remain an ideal choice for risk-averse, investors who want to prioritize, safety of their capital, who want to prioritize stability over fluctuation. Whichever one, it all depends on your risk tolerance, your investment horizon, and your overall investment objectives. So if you want to consider investing in bonds, please look critically into these disadvantages and see whether you can bear them or whether you cannot bear them.